I would say it's a number of factors all clustering in at this moment in time. First and foremost, if we look at the price, as you mentioned, there's a narrowing in of breadth, and this is this ongoing story of Tech Street, Wall Street, and Main Street all diverging. Now, of course, or the tech sector and the Nasdaq in particular, and Wall Street, Dow, and S&P 500 narrow their performance together of late. But if we look at the equal weighted index of the S&P 500, it's barely broken above its June peak and has actually been flatlining ever since. So we can see there the fantastic divergence, as I call it. And then, of course, looking at the Russell 2000, the broader index with some of those zombie companies, very much looking the same in terms of equal weighted on the S&P 500, below the June peak and actually lower. And particularly if we look outside of the US at the rest of the world, the UK here in this home base is actually quite negative, and we've had a new range breakout to the downside. So breadth is an issue. Second thing is, if you look at liquidity and volatility, it's quite interesting. ETF flows on the S&P 500 is at a new record low. And if we take a look at the VIX, that's also been in an interesting atypical spike up as markets go up, suggesting potential hedging for downside risk.
So, Ron, are you suggesting that technology also starts to reverse at some point? If the overall S&P 500 is also going to face a decline, does that suggest tech's going to drop? And what size of a decline are you anticipating on the S&P? Yes,
well, a Minsky moment suggests a sizable decline or collapse, crash. So anything in the ballpoint of at least 20 to 30%, if not more. But certainly this V-shaped recovery would potentially be a false one and would lead into a rolling W retest of the March crash low. So that would be around 2,200 on the S&P 500 and various other figures elsewhere. It's no big surprise. I think a lot of the prudent investors have been saying valuations are quite high. We're also approaching the negative seasonality of late August into early September. I do warrant caution here because, I mean, this has worked on most years, but this year, above all years, I mean, of course, because of the nature of this a black swan year and VUCA environment that we're in. But more than that, we've got a cluster of cycles, the presidential cycle turning negative into November, and we also have a big decennial cycle, which is also down for this year. So there's a number of reasons why the market will be searching for pockets to potentially correct. And also just on a very simple level, I mean, this would be healthy as part of the general market structure, where we could have a multi-year repair period before that long-term bull reappears again.